Hi, I'm Jim Jubak, and welcome to my latest YouTube video. I hope you like my new setup, where I'm trying to upgrade a little bit for you. So we've got a new light, we've got a new camera, so I think this will look a little better. It's a beautiful day here in New York, the kind of day that Ernie Banks, my childhood baseball hero, would have said, "Let's play two." It's not Ernie's fault that he led me to believe I could be a shortstop, major league or otherwise. I still hold, I think, my high school gym class record for most consecutive throwing errors by a shortstop. If you want more of my stuff as opposed to Ernie Banks talk about the stock market, you can go to my site, jubakpicks.com, that's my free site, or jubakam.com, that's my subscription site. The subscription site has more portfolios than the three that are up on the free site. My tool for the dip, called the Dipometer. So that's the Jubak AM site. If you like this video, please like it. If you want to see more of them, please subscribe. Okay, today the title is 3 Picks for Continued Volatility. Part of that is 3 reasons the volatility isn't over and things you can do about it. The reason for the volatility not being over, pretty simple. Three things. One, economic growth. That we're looking at a year where the Wall Street prognosticators are saying 7 to 8% GDP growth. That's the plus. So you've got that carrot sitting out there dangling over the market. Everybody going, GDP, GDP, GDP. Yes, important thing to remember is that the market is not the economy. We can have a market going up when the economy is doing nothing, like last year. We can have a market going down when the market's doing great. But anyway, you've got that carrot out there, which constantly will lead people during this year to go, I need to put more money in the stock market. Okay. The worry, however, about that 7% GDP growth is the reason for number 2, volatility. Worries about inflation. We have inflation numbers this morning. There's no inflation in the economy. In February, we saw core inflation, that's inflation without food and energy prices, go up a whopping 0.1%. If we put in gasoline, because gasoline prices went up about 6.4% in February, we still get up to only 0.4% inflation in the month. The Fed is looking for 2%, saying if it goes over 2%, we're okay with that for a while. But the stock market, Wall Street seems to be really, really worried that with all this growth and the Stimulus and Relief Act of $1.9 trillion, plus some infrastructure spending, we might see inflation explode. Okay, I think that's really unlikely, but the worry is there, and every time we get an inflation number, we're going to see bouncing back and forth. Today, the market is up on low inflation numbers. Tomorrow, who knows? Third reason, interest rates. Right now, we're seeing the yield on the 10-year Treasury bond, which serves as a benchmark for things like the mortgage market. Zoom, we're up to about 1.61%, which doesn't sound like a whole lot as a yield, but remember we started off the year around 0.9%. We've recently come back down. The reason for the rally on Tuesday, March 9th, was a dip in the yield on the 10-year to about 1.41, 1.45. Every time the yield goes up, people, it makes stocks, gives stocks less of a competitive advantage versus bonds. It also leads to worries that the Fed is going to finally start to go, hey, growth is strong enough, so we'll stop buying $120 billion of treasuries and mortgage-backed assets every month, and we'll start to trim that down. And the Wall Street will then say, well, that's just the lead into some kind of increase in interest rates in 23, 24, something like that. So every time you see the 10-year rate bounce around, we either get a rally or we get a retreat, whatever. So what should you do about this? Let's go to some charts. One of the things to realize is to look in your soul and go, okay, how much volatility can I take? I've got a chart here of Tesla, a market favorite, but you notice that Tesla is also an incredibly volatile stock. So if you're not comfortable with this degree of volatility, if this degree of volatility makes you go, I got to sell, so that you constantly are getting whipsawed and selling at the bottom and then buying it back in at the top. This is not a kind of the stock you want to own. And you also need to look and see whether you actually own Tesla and its volatility and other things. For example, Tesla is a portfolio member in SMOG, which is a Van Eck low carbon ETF. SMOG is this future. Tesla drives this a lot of volatility in this otherwise alternative energy fund, so maybe you don't want to own that. Okay, so look and see how the volatility of what you own matches up with your own sense of volatility. Two, and let's look at the chart for Applied Materials, which is that I think in this marketplace where volatility is going to be with us for a while, you probably could make some money if you just played with a few stocks that you knew really well, and where you had a good sense of what the volatility was. This is Applied Materials, which makes equipment for making semiconductors. Long term, this is a stock that I really, really like. Long term being 2 years. Capital spending trend is way, way up. Because we've got a chip shortage for all kinds of things like automobiles, 5G. So chip makers are buying equipment from people like AMAT. But you notice that whenever there's a dip, this is relatively, not an incredibly volatile stock, but you're talking about 122 down to 115, and then back up to, actually not 115, 108, back up to 113, down to this. I think, if you were to say, okay, I'll buy it when I see a dip because I like the long-term story, so I don't have any problem if I own it for the long term. We own Applied Materials in some of my online portfolios. In my own personal account, I'm trying to give myself a little more trading leverage for this. So I'm using some of the call options. I'm using the June 18th call at an exercise price of strike price of 120. And you're getting, good volatility play in here on this. So I'm buying it, selling it, buying it, selling it. You don't need to do this with a lot of stocks. In fact, you're better off with a few that you know really well. And the last thing I want to talk about is Disney. Contrast Disney to either the Tesla or the Applied Materials chart. You'll notice that while there's some volatility in Disney, you're looking like a big swing from 201 down to 196 and then back up. And the long-term trend here is just up and up and up. Disney is a stock which has been riding high on huge growth in its streaming business, Disney Plus, and on April 1st, April 5th, we're going to see the theme parks in California open up for limited attendance, but they will open up for the first time, so that this is a good vaccine recovery stock. So here, I think your third option, rather than sort of making sure you don't, Tesla, making sure you don't own volatility that you can't stand, B, trading volatility, and C is the possibility of just ignoring it. As long as you've got an upward trend like this in a stock, these bounces day to day aren't terribly important. Maybe this is a dollar cost averaging strategy in play here, so you buy more when it dips, but you really don't need to be worrying so much about the day-to-day volatility. It shouldn't scare you out of this. So Disney is a stock, and there are a few out there. Caterpillar, I'd suggest, is another one, where you could basically say volatility, schmolatility, okay, I'll just own the long-term trend. So that's my sense of how you play this volatility. The volatility, I think, is going to be with us. I think the market is going to be trending upward. I don't think you can discount animal spirits. It's just beautiful. The weather shouldn't really affect your decision on stocks, but it does, because people are human beings. So the fact that I can go out today and sort of bask in the sun and eat outside rouses the animal spirits in me and makes me more optimistic about the market as a whole. We're seeing more vaccines roll out. We're seeing when people go outdoors as opposed to being indoors, we'll see the transmission rate go down. All those are good things over, say, April, May, June. I think when we get to July, August, September, the big thing playing here will be, what is the Fed doing? What is the Fed saying about when it's going to do anything on bond buying? So I would look for a general trend upward with lots of volatility as we worry about these three things that I sketched in here: economic growth, inflation, and bond yields. But I think we're up through June, and after that, it will largely depend on what the Fed does. And the lesson of the last few days is since the fear of what the Fed was doing was produced that big sell-off, you can imagine that the Fed actually saying something concrete might produce more volatility on the downside. This is Jim Jubak. Please check out my site, jubakpicks.com, subscription site, jubakam.com. Thanks a lot. Don't forget to like and subscribe.